morning, everyone. I am Audrey Boissonou. This is Mortgage Pros 411, and I'm here with my co-host, Kevin Casey. And today we are joined by Maureen Mclnerney and Tony Migliavacca.
You need to practice that. Well done.
Did I?
Perfect.
Was it right?
Yes, both of them are right.
Okay, I knew yours was, but Tony had no expression. I was waiting for him to go, okay, that was wrong.
No.
Anyway, welcome everyone. We are so happy you're here today. Tony and Maureen are with Interland, and they are condo specialists.
Inter-island.
I'm gonna fuck that up. Inter-island. Okay, so you're in Louisville, Kentucky. Which island is close to you? I would like to know.
Okay, so there's one right in the middle of the Ohio River. No. So we were founded about 40 years ago in Florida, in Bradenton, Florida. And it is very close to Anna Maria Island and the Intercoastal Waterway there. So that is where the name originated.
Okay, that makes a lot more sense. Thank you so much. Okay, so a few things before we get rolling with all things condo. And just in case you're an LO and haven't noticed, we have some issues, you need to get out from under your rock. So we have California MBA, Mortgage Bankers Association, they're having their legislative day today in Sacramento. So hopefully a lot of people are there. But they're also doing a Mortgage Innovators Conference May 8th through the 10th in Anaheim. And we went last year. It was awesome. Very interesting. And, you know, they can use a little LO input into some of this tech stuff that they think is so fantastic, because sometimes at a 30,000 foot level, it sounds great. And by the time you get down to the consumer, not so great. So, but always interesting to know what is coming and what they're talking about and what the conversations are. So they are doing something where they're letting LOs in for free. They know that things aren't fantastic in our world, but there you go. And on that note, again, I'll do this quickly. I saw this on MBS Highway and I thought it was great. So monthly real estate sales, this is really good to know for all of us who are like, there's no business. We have to wait for the rates to come down, which is utter nonsense, especially since the odds of the rates coming down just diminishes by the day. We are down to, remember, Kevin, when Dan Habib was on, we were at, it was a 48% chance we were going to have a rate decrease in June, right? By last week then by the next day, we were down to like 22 or 23%. Last week we had Dr. Lawrence Yoon on. It kept going down. Now we're at a 45% chance of a rate cut in, you ready? September. Okay, so for everyone who's sitting around waiting for the rates to come, in
other words, wait until January.
Get over it, people. Okay, so take this, write this down and put it on a sticky note in your bathroom mirror so that you remember that there is business out there, okay? There are, on average, 407,000 real estate sales per month right now. Got it? 407,000. Now, there's a lot of cash. I'll give you that. But that means that there are 293,000 real estate sales with a mortgage. That's 72%. And then on top of that, 32% of the market is refis. That's 138,000 more refinances, which adds up to, fast math, 431,000 mortgage transactions per month right now, with the rates sucking. So, or being fine or normal or whatever we're going to call it today, depends on my mood. So go and get some loans. Go get some loans. So with that, one of the things that we have noticed is a huge challenge, and I want to give a big shout out to the San Francisco Peninsula Camp chapter. This was originally their idea, that we do a show on condos. And it was such a great idea. And so what we did first was reach out to who? The GSEs, Fannie and Freddie. So this is what happened.
Wait. Weren't we supposed to have Fannie and Freddie on the show?
That was the original idea, yes. And so we reached out. Fannie politely declined almost immediately. Freddie, we pinged numerous times, no word whatsoever. So we're not sure they're still there. I don't know, I'm assuming. The fact that our GSEs are not willing to talk to us about this is a little disturbing for me personally, but we were lucky enough to happen upon Tony and Maureen. And in my conversations with them, we are in for a treat. I mean, you know, a condo treat, an HOA treat.
Is there any other kind?
With that, it feels like a minefield out there, and I'm really interested in exploring what an LO or an AE or whomever needs to know about condos and HOAs and what's going on. So where would you guys like to start?
Well, I think there's two major flags that are going on right now that we're seeing a lot of. One is insurance, not being able to buy insurance that meets the guidelines, insurance policies that are playing fast and loose with some of the terminology, and you have to kind of go back and clarify and get more detail. So a lot more look on the insurance, and then of course the deferred maintenance and critical repairs. Those are the two big ones. But yeah, I think that we could do the whole show on those two, probably.
Right. Yeah. Doesn't that sound titillating? But it's a problem. It's a big problem right now because
Especially in California with insurance.
okay, here's the funniest part, Kevin. So
Louisiana maybe also.
It's not just in California.
But it's very much in any coastal area, it's really hitting hard.
So I had a comment from someone in Southern California, a realtor, who said, we don't have that problem down here. So can we start there? I mean, is this regional or are they scrutinizing condos everywhere? Tell us what's going on.
Well, obviously the guidelines are applicable everywhere, right? So, but I will say that we have seen the greatest challenges and issues in places like California, Florida, Louisiana, places where the insurance companies have paid out massive settlement or, massive claims. And so what they've done in response to, paying all of those claims is to increase the premiums, sometimes up to 500%. So the HOAs are absolutely, financially devastated by this. So not only are the premiums going up, but it's in some of these places even hard for HOAs to get wind insurance in the standard insurance market. So like, for instance, in the state of Florida, Citizens Insurance exists, which is an actual entity, a state-owned entity that allows HOAs to get insurance when they've been denied, categorically in the standard market. But the problem with that is that Citizens isn't issuing wind insurance in the same amount as the property, like that it doesn't match the HOA's property. And the GSEs require that the insurance amount be the same as the hazard amount. And so that's something like that right now we are trying to work with Fannie to say, hey, if these HOAs have got Citizens, de facto, they're not going to meet that. And are we going to punish all of those HOAs for that? It's, it's not their fault. So, and then one of the ways that they're trying to keep their insurance premiums down is by electing to have per unit deductibles, which we never saw before.
Oh, wow.
So it's very common, especially, I think, primarily in Florida, not just Florida, but primarily in Florida, where HOAs are electing to have a per unit water deductible. So for water damage, well, we have to, in the way, because of the way the guidelines are written, you have to take the number of units and multiply it times whatever that deductible is. So if you have 100 units in your project, you have to multiply that, times 20, let's say it's a $25,000 water deductible. And if that number is more than 5% of the face value of the policy, you're out of luck.
Wow.
So they've managed to kind of save on their premium, but unbeknownst to them, they have now just taken out insurance that makes their project ineligible for conventional financing. Well, it's not true for FHA right now yet, but for Fannie and Freddie.
Okay, so we're going to go into some of the difference between the GSEs and HUD and then non-QM. I just want to point out that someone posted in the chat that their son was canceled in Nevada. So this is happening all over the place.
Yes,
all over the place. So lest you think that you are excluded and
no, I would not think that anybody's going to be immune. I mean, you see it happen initially in certain places, but that doesn't really surprise me.
Well, and I just saw this monster storm that happened in Ohio where my friend's like boat and boat trailer had like landed, been taken from one spot to another. So just again, the reason I'm pointing that out is that people, less,
Yeah, no,
it
I
isn't.
know one in Colorado with hail damage. It's a real problem there.
Right.
Yeah.
It's really
So
hard to
just
get.
listen up, kids, because this could be coming to an HOA near you.
Yeah.
So, okay. So you guys, so just to be clear, so the way that I was connected to you was I called my condo desk and I said, I'm looking for experts. And they said, you should call Tony and Maureen. And so you guys handle I know for our company, all of our full reviews. And also, Maureen, you were saying that most condos, we used to think, oh, you get a limited review, that's going to be great. And explain what's happened with that.
Okay, so because of the deferred maintenance and the critical repairs and special assessment requirements that are now, they started as temporary guidelines and now they are permanent. All of those requirements apply equally to a limited review and a full review. So there is sometimes a misconception that if you qualify for a limited, because your LTV is low enough that you can kind of circumvent this very thorny area.
Yep,
and that is
that.
Not true. Like really, when you get down to it, the only difference anymore between a limited review and a full review is, we're not having to verify that the budget shows, a 10% allocation for reserve funding. That's pretty much the only difference now.
Wow, that is crazy. And you guys were talking about the repurchase issues. So we've been talking about the IMBs, the mortgage banks, having a lot of requests from Fannie and Freddie over the last 2 years or so to buy loans back and, performing loans back. Well, you guys had mentioned that that's happening on condos as well, like for that reason. So can you explain that a little bit? Like, so you can close your loan and then find out you're in trouble still?
Oh, absolutely.
Yeah.
Really?
I mean, I'd say for the last year and a half, it has definitely slowed down.
Yes.
It has definitely died down, but
like the number of repurchases.
Okay, good.
But yeah, I mean, Maureen had a full-time job of writing rebuttals and going back through. Some of them were very easy to defend. So I think there was a quality control portion there that was throwing back loans, and they were pretty easy to defend. But it still took a lot of time and I think heartache for a lot of lenders.
Right.
So yeah, that has definitely, and I think we were talking about this offline, that you learn a lot during that time, what they're focused on, what they're looking, and similarly, I did want to mention, Fannie has really kind of gone back and boosted CPM usage, and now require it for full reviews that people certify.
Wait, please hold. Explain acronym, please.
Oh, sorry. The Condo Project Manager. It's an online, and they now require all lenders to certify a full review in CPM.
If you're selling to Fannie.
If you're selling to Fannie,
wow.
you have to go in and certify.
Wow.
What we've seen is, and just kind of going back to these insurance deductibles, different things like that, we've seen Fannie approved projects flip from Fannie approved to unavailable, which is their ineligible status, overnight for some of these things, because the lenders are required to report if something's ineligible. So we're seeing that flip a lot.
Yeah.
So just be mindful.
So just because you pulled it up in CPM and you looked up a project and it shows that it's approved, if in the course of your review you find that it now has ineligible insurance, you as a lender are required to report that, and that project is going to go from approved to unavailable, like that.
Okay, so one of the issues that I feel like we're up against is I've got a buyer, they're looking at condos. How on earth do I guide them as for what to do, what to look for, and what should be written into a contract by a realtor to protect everyone in the event that something like this happens? Because you can go in and be fully credit qualified, income qualified, the appraisal comes in, everything's groovy, and then all of a sudden at some point the project becomes ineligible and you're, a week out from closing. What do we do?
Yeah, well, the first part of your question is kind of hard to answer. Well, let's take the contract part. it would be highly advisable that in the contract, you know, there is a provision that states that if in the course of due diligence, which hopefully happens very early in the process, you know, and the borrower gets a copy of the budget, the, you know, the COI, those kinds of things. If there's any factors in there that are going to cause the project to be ineligible for conventional financing, then, you know, the buyer, you know, gets to keep their escrow, what have you, because this is just too common. And you can't, there's no master list. There's no way that you could just, you know, look at a listing and think, okay, this project has, you know, acceptable deductibles. And I mean, you're going to have to get those docs to do the due diligence. So you're just going to want to make sure that your contracts have an out, so that when you do that and you find one of these things, that, you know, your borrowers aren't going to be punished for that.
I have been telling realtors literally forever that they should get all of the condo docs up front, the HOA certs, etc. But even when you do that at this point, the mechanism to have them reviewed by an expert like yourselves is rough. Like, you can't just, you know, like, lenders don't want to put everyone through that process unless they've got a loan in their system. And I get that. That makes total sense. And so we're all sort of floundering around, and then realtors are going, we don't have a problem. It should be fine. And also, you know,
this is on you is the way they look at it.
Yeah, they're like, and so what you're saying though is that we can go through all this, and let's say we get the HOAs done, I mean, immediately, right? So how long does this process take? Let's say we submit a loan to an IMB, they submit it to you for a full review. How long does that process typically take?
So our review time is fairly quick. Somebody just made a comment about getting the information from the HOA is the biggest time constraint. That's absolutely true. We've seen some lenders move to almost like an appraisal model, where the condo review is a prepaid or borrower paid or branch paid or something, where they're paying that up front and saying, you know, and they'll make it some big fee that includes, because the doc collection costs more than the review. Our review fee is minimal compared to some questionnaires cost more than our review fee.
That's actually very common now. Like,
very common.
That
it's right.
Yeah, the condos are looking at it as an income source.
Yeah, no, absolutely. Yeah. And they know the borrowers have to have it. And so, and then they are nickel diming. It's this much for the budget. It's this much for a questionnaire. It's this much if you need the condo deck.
Right.
So yeah, and we see
or they're incomplete.
Right. Or the questions aren't even answered. So we have to go back. But when we get a submission, we look at it the same day. Okay. And in a perfect world, if we were to get everything that we needed, it's not uncommon that we could get an approval out the same day. But again, it's getting all of the information and also getting either the HOA or the management company to answer those deferred maintenance questions, right? They're fighting tooth and nail. They're giving you boilerplate that says nothing.
Yeah. And minutes from 2 years ago.
Yeah. We're like, okay, give us the last 6 months minutes. Like, we at Interlands tried very hard to, you know, have multiple ways to get from A to B. But yeah, like, so they won't answer the deferred maintenance questions. Okay, well, give us 6 months recent minutes. Well, they're from 2 years ago. And it's just this clawing back and forth of, you know, trying to get this information. And it was not like this, you know, previously. So
yeah, I recently had a condo purchase, and it was a nightmare, but the nightmare wasn't on your side. Like, I was really impressed with when we'd send the conditions in, how quick the response was and how logical the answer was. But the issue I was having is the verbiage. So my underwriter would say, we need the inspection reports. And the condo association, well, there is no inspection reports. And so then I literally have to take the time and read the minutes. And in the minutes, the contractor reported on dry rot damage around a chimney, right? And I said, and it was said that in the minutes. So I'm like, well, where's the report where this happened? They're like, he didn't give a written report. He gave a verbal report. I'm like, hold on a second. I think we're talking two different languages. My underwriter is asking for a report, and you don't have a report. But what you do have is, I bet that contractor gave you an estimate.
Sure.
And they're like, yeah, he gave us an estimate. Give me that estimate. That is a report. And that solved all the problems. But until I got figured out that we were talking two different languages, and once I talked their language, then they were able to fulfill the condition. We were just butting heads.
Yeah.
You know, and unfortunately, I had a real estate agent that needed to be on Xanax. Yeah, it was pretty rough.
Yeah. I mean, I've been telling my buyers forever, again, forever, that's a long time, that they should get 12 months meeting minutes from the board meetings to see what's being discussed. Do they think they're going to need a new roof in 3 years? Do they need, what is the conversation at the board meetings? And it's always shocking that not every realtor thinks this is a good idea, because again, this is all about protecting our borrowers, right? What is coming down the pike that they need to be aware of? And if they go into a situation, and I mean, I'm seeing it on Nextdoor right now. There was this guy who was freaking out, wondering how he could sue his HOA and all this stuff because they were raising his dues. And I'm like, buddy, like completely out to lunch and either there's no communication between the board and the management company and the owners. So they don't understand what's going on with insurance and with all of these different rules and new rules that are coming up, but it is something else. So somebody said they live in a condo in San Jose and they have Hartford and no problem. And even if you don't have a problem today, that doesn't mean one's coming down the pipe. You said that the renewals are coming in from the insurance companies,
right,
and sometimes they're 500% higher. It just comes out of nowhere and you don't see it coming. Yeah. Brenda made the point, which is a good one, that if Fannie and Freddie recently approved a project, that talk about that, because the recent approvals where you haven't had an insurance renewal again, that's a whole different thing. So talk to that.
Yeah. So obviously you need to look at this, as the whole picture. So if it has just become approved and, you see the date and you have a COI and you can see that the insurance that's currently in place was in place prior to the approval, that's probably not going to be an issue. But, that is the minority of cases. So, but what we just want to highlight is that just because you look a project up in CPM and it has an approval does not mean that at that moment something hasn't changed. And again, there's an obligation on the lenders to disclose that. And now if a loan closes and it was approved on the date that it closes, funds, then Fannie will honor that. Like we did have that happen. Okay. Where a project became unavailable subsequent to, I mean, in a short period of time, but still subsequent to the date it funded, Fannie honored that. But again, we just want to make people aware of the fact that this stuff can, turn on a dime now.
So are they running this report? Like, is it like a credit report that you run one more time 48 hours before funding? Are they running it all the way up to the end? So you can get all the way where you've signed, everything's done, you think you're good to go, and boom, you're done. You can't close?
That is our understanding, that is an obligation on the lenders to go ahead and run it. Like that's the first thing that we do when we get a submission. The first thing we do is we pull it up in CPM and we see what the status is. And, we've advised our clients that, even after it's been certified in CPM, you want to pull it up and see if anything's changed.
Yeah.
I mean, it's not super common, no. but it's a thing.
It happens. Okay.
Yeah. And I'm saying that's why the minefield analogy is pretty accurate.
Yeah. So we, so COI is certificate of insurance, just to be clear. Yes. Yeah. Okay. You said it a few times. I just want to make sure everyone's following the acronyms. Usually Kevin is the acronym police for me. And so I'm taking that role on today. I don't know.
Yes.
Kevin, I don't mean to take your job. So someone made the comment, don't remove your appraisal contingency until you have a condo warranty. But from what you're saying, what is a condo warranty? Let's start there. Like explain that. And then if they're running this report all the way up to funding, does that save us or not?
I mean, the warranty is just our approval. So if you use
Okay.
you use condoreviews.com, use Inter Island, then that's our approval letter.
Inter Island.
Yes,
Yeah.
but
Island.
the sorry, I forgot the second part of your question. I just lost it.
Versus loan.
Yeah, yeah, right. And so what we're seeing a lot of our folks do, and this is something that we're perfectly okay with, is that they will send us all of the docs, the insurance, the budget, what have you, and we'll say, okay, everything's good. And they're like, okay, now we'll order the insurance. I mean, the appraisal. We're totally okay with that. So, because that, we understand that's another $500 the borrower's paying. So we can't issue the approval without the appraisal, but that does often make a lot of sense, because if there's going to be a problem, you don't want your borrower, paying for an appraisal on a project that has a 10%, wind.
So for a real estate agent, shouldn't they be proactive in ordering all this stuff up front and providing it to the buyers?
As much as, yeah, I mean, as much as possible.
I mean, a lot of times the owner has access to stuff for free. That's
yeah.
That's kind of what I was arguing with them.
Yeah,
like, you can get me, you can get me all the minutes, you can get me all this stuff. You're an owner, you can get this stuff. Why are you not getting this stuff?
Yeah, so ask for it.
You have to pay $100.
When you put the offer in, because as a unit owner, that's the good news and the bad news with owning a condo, right? It's a common interest ownership. So every unit owner in there has every right to a copy of the budget and the minutes. And, maybe not a completed questionnaire, but if they're not asleep at the wheel, then they should know if there's litigation. There's slip and fall. And if there is, has their insurance company agreed to defend it?
Right.
And a lot of times too, people say, well, yeah, there's deferred maintenance issues, but they're not in my building. Well, remember that when a condo project is reviewed, it's the project.
Building. Right. Yep.
Not a unit, not a building, unless it's a single, you know what I mean? But it is the project as a whole. So the fact that it's only the decks and hand railings that are failing in 3 of the 5 buildings, and your subject unit isn't in one of those, that doesn't help, because everybody sinks and swims together.
Right.
Now, when it's a trip and fall, that's not such a big issue, because that's
as long as the insurance company has agreed to defend it.
Yeah.
Right. So I saw one of these reports where they had basically a map of the complex, and they had done a review of all of the balconies and everything, and they had put red, yellow, blue, green on as color code what was done, what wasn't done, what was the problem. And so the lender's requirement was that all the yellow and red had to be addressed. And although my client's condo unit had been handled and was fine, to your point, it was the overall HOA that had to be done completely, and all in the green or blue, or I forget what the blue meant, but anyway, I think we can guess what the green meant. With that being said, it's really, and this is going to be a very important re-education process when it comes to realtors, because the realtors are going to have to educate their buyers. I mean, their sellers. The sellers need to understand that all of this happening is going to could potentially impact their values, their ability to sell, their ability for some, you know what I mean? And so everyone needs to be aware of this. It's a big deal. So if you're looking for a reason to communicate with realtors, to do a similar, go into an HOA, hold a meeting and bring in an expert like Tony and Maureen, and make sure, and be careful about being that expert, because you want to make sure that the information that's being conveyed is really dead on, and that you're not giving misinformation. So be careful, but do it. I mean, you've got to, it's our job. We can help educate people so they understand what's happening, and that this is all over the place.
Now, speaking of experts, we heard the story in San Mateo where there's this expert that's advising real estate agents not to provide any information on condos. Remember, we were talking about this with Alan Kurth, and it's like, yeah, that doesn't do anybody any good. So you sell cash.
Yeah. So that means you have to have cash and stupid buyers. People
Yeah.
who are absolutely uninterested in what they're buying. So, and
Yeah,
by the
and
way,
that's
if
it.
you,
Yeah,
I don't know, Maureen, what from your perspective as what were you again, an attorney?
I am an attorney.
So
Yeah.
if somebody suggests that we don't disclose something in California or anywhere,
Not a
and
good
then
idea.
there's a problem later, any liability issues that
Well, I mean, the thing is that even if you take it out of that realm, you, as the realtor should be encouraging the borrower to be fully informed about what they're signing up for, because again, like you said, you know, you are becoming financially linked with this project and with these people. So you want to see that the budget is sufficient to cover the operating expenses.
right.
Don't buy a condo in a project where they're operating at a deficit, because that will come back to haunt you.
100%.
Right?
Yes.
You're going to have special assessment after special assessment, you know, and those aren't the things that you've budgeted for.
Right.
Or, you know, again, you're underinsured and something happens, you're all going to pay for that, right?
Right.
And that's
I had that come up. There's a condo association, Walnut Creek, that Audrey's always talking about. And I had a client who was looking to buy in that association. And I literally said, you can buy there, but I'm not going to be the lender on it.
It is, I literally have made people sell in there just because it is so, this is an HOA that for all the decades I've been doing this job, they've always been in litigation, and not just one often, but multiple problems at a time. And their
that's like
insurance,
a big red flag to a
yes.
borrower.
Yeah.
And now their HOA dues are off the charts. So you can have a $300,000 condo unit, like a studio or one bedroom, which in this area is unheard of. But the HOA dues might be almost $1,000, you know, and then there's special assessments, and they're a mess. And their attorneys and insurance companies had told them the same thing. Don't provide the information, don't do this. And it's such a disservice to the owners, to anyone, because you're
Right.
really devaluing your asset.
Yeah, I
You're
mean,
not making it so you can get a loan on it.
yeah, stonewalling is not helpful.
No, it's a disaster. So
Yeah.
again, we have to educate people and help them understand what's happening out there. So there was a really good question. We've learned about this recently in California. I didn't know before all this mess with insurance companies happened that there are unadmitted and admitted insurance carriers in a state. So is there a problem with using an unadmitted carrier is from the perspective of Fannie, Freddie, and HOA?
No, really,
Okay.
the emphasis is just on their rating, you know, whether it's an A plus, that kind of thing, because we often see unadmitted carriers in the state of Hawaii.
Yep.
So that's ultimately, that goes to whether or not this, you know, if the insurance company fails, what right or what responsibilities the state has vis-a-vis that failure. But the GSE guidelines, to my knowledge, don't address that. It's really the AM Best rating. You know, they just want to make sure that they're solvent and all of that. But there are so many data points that we are looking at right now. You know, I don't know anybody that actually checks that. To be really honest with you, I mean, right now we're looking at all the necessary perils covered, because we're starting to see more basic coverage, which doesn't include water damage, which you have to have. So, but basic is cheaper than broad or special. And, you know, again, all of these things that, and I'm not throwing shade on the HOAs, they're trying to make this financially manageable. But again, either, you know, and it's not, I don't think the insurance companies are like, hey, go ahead and take this per unit deductible. It's going to really lower your premium. And oh, by the way, you're now ineligible for conventional finance.
Right.
And they don't know what they don't know.
Yeah.
And, you know, it's just really hard. It's really hard to navigate.
Well, okay. So I just want to take a moment and just say that it took 34 minutes in to get to a point where we had some good news, which is we don't just have to use admitted carriers. We can use unadmitted carriers as long as they follow all the guidelines. Yay. So we have a few more options, right? So just another shout out when you're looking at insurance use a broker who has a really strong work ethic and is very innovative and creative, like we have to be, so that we're looking at all the different options, right?
Yeah, but you also, you know what, today with insurance, I used to always be the big fan, just going to having my broker and I'd send this stuff to him, and he 9 times out of 10 have a better offer than any of the other my clients' offers, and he'd get the deal. But now I'm seeing that you actually have to call around and check some of you guys that don't broker. Also, you know, the AAAs and the Hartfords and the, you know, kind of get those companies. I don't know if Hartford brokers or not, but there's a couple of companies out there that don't broker and they're separate, but they're still doing insurance. So you have to like call around, and it's a job.
Well, the other thing you've got to watch out for, and I just learned this the other day speaking to an insurance agent, you got to be careful about recommending a place, because if it goes belly up or they deny a claim at some point down the road, your E&O insurance could be looking at you saying it's your fault. So this particular insurance agent has stopped writing Fair Plan in the state of California because his E&O insurance says they've said that they may be insolvent if there is a huge catastrophe. And therefore, if you write a Fair Plan policy knowing that, and then their claim is denied, you could be on the hook and we're not going to cover you. I mean, how about that? That wouldn't have occurred to me in, even a few weeks ago, let alone, you know what I mean?
Yeah.
Crazy. So be really, really careful. It is, yeah. So Dirk had made a comment, what about the rush fees? What is it for? Yeah. I mean, the rush fees are ridiculous. It is, I always think you are gouging your customers. When the management companies are charging these fees and these excessive amounts of money, you're on HomeWise and they've posted everything on HomeWise and it costs how much? I mean, it's incredible. But this is, it's like a parent abusing a child. The HOA is in a position, and we had the at that point the DRE commissioner on our show a couple of years ago for the Department of Real Estate in California. And I was going 13 rounds with an HOA that I was irritated with. And I said, who monitors them? Who looks out for them? And the answer was no one.
No one. Right.
No one. There is no, when we think no regulatory, we have too much regulatory oversight. This is what happens when you don't have any, right? So you get the boards that have predominantly people with time on their hands, no necessary financial background, construction background, any ability to look at anything other than okay, I'm going to stop because
it's
anyway,
it's like I know somebody just got on the board.
The wrong people making decisions in a lot of cases, not every case by any stretch, but a lot of cases.
Yeah, no, I know somebody just got on a board and like, okay, well, here's the things you need to be looking for. And so in California now we have a law as of January 1st, all decks have to be inspected in all condos.
SB 326.
Yeah. And it's a real rush now to get contractors out there to inspect the decks. And I've also said to a friend, I said, you might want to almost have the budget built in for what you're going to spend on the decks before you get the report back, because you don't want to get the report saying we have 10 decks that need to be replaced, and then you're not going to be able to do any closing loans on that property until those decks are finished and repaired.
Right. And we've had that come up, that particular issue come up, right? Because the HOAs that have already had their inspections done, and, Audrey, what you were talking about, like red, yellow, green, we're like, okay, well, the red and the orange or yellow, whatever, those have to have been done, right? So the ones that, are still structurally sound and safe, it's okay that those aren't done, but, the ones that are actually, have the dry rot and all of that. So, but you're right, Kevin, that, you want to be ready to have, money to go, because that is very likely going to trip up any kind of closings that are happening, especially while the, the really urgent repairs are underway.
So we have a comment from Krista, and she says, all really great info. And she's looking for a list. Like, is there a list of what to ask for up front? How do we help, how do we help?
That would be really helpful.
Realtors and clients. How do we protect everyone? And so you and I were having a conversation earlier today, because I was asking, do we as LOs, because I know that our that companies can go to you and contract for your services. But do you have a mechanism for LOs and or realtors that we could get ahead of the ball game a little bit on this with some service that you could provide? So again, we had talked about LOs, and now I'm realizing, you know what, realtors could be part of your business plan, right? Because that would be, I think, helpful.
Yeah, I think there's a couple of things. One, you're welcome to get our checklist from our website just for what we're going to require to review.
Okay.
So they're right.
And that's condoreviews.com.
Condoreviews.com under forms. It's the main things: full, limited, single unit approval, that kind of thing. So that's helpful to have going into it. Like, okay, maybe you can get the seller to provide it, whatever. And then secondly, we have a scenario desk in the works. Part of the issue, and I think we were talking about this earlier, we're doing a lot of free work because we love our customers and they have a lot of questions. But it's taken away from getting the job done as well. So that is definitely, it's been in the works for a while of how to implement it and give that access where we can answer some questions, some scenarios, and have the time set aside to do that. So in the works, more to come.
Yeah, and the other thing that we're working on is just having a couple of FAQs that would also be available at our website. Like, what are the things I need to be looking out for with respect to insurance? Because there is, and Audrey, you mentioned this earlier about people thinking that they have the information straight and then sharing that with other people, and it's not correct, and that causes massive confusion. And one of those things relates to the per unit deductibles. Guys, if you see a per unit deductible on a certificate of insurance, stop, do not pass go, do some math, and figure out if that's going to work, because I would say 95% of the time, a per unit deductible is going to be a problem. It's going to be more than 5%. Now, here's the thing. There's an exception in the guidelines that states that if you have a per unit deductible for a geographically specific peril, it can exceed 5%. Bad news, water is not geographically specific. We're talking about, a pipe breaking, sometimes sprinkler leakage is different, or somebody's bathtub over, like whatever it is. Water can happen anywhere. Right. We're talking about that. So that is a very limited exception that we get beat up about almost every single day. Like, there's this exception. I'm like, we're talking volcanic eruption, ice damming, like something that is very specific to earthquake is actually not a required peril.
I know, that's amazing, huh?
So you can have a 10% earthquake deductible. But again, you've got the blanket deductibles versus per unit. But again, that's been a huge source of misinformation where, we've got people just like this, we know. And I'm like, I have gone straight to Fannie myself and said, am I reading this right? And they're like, yes, Maureen, you are. Okay. So, that is only complicating what is already a pretty challenging situation right now.
I would like to encourage you to prioritize getting us a scenario desk and a subscription service of some sort. I don't know how we do it. Like, maybe we do it that you can ask 5 questions. Maybe why don't we like decide, okay, you can have 10 good questions a month and then 2 dumb questions. Otherwise the price goes up. I don't know, something like that. What do you think? So
you ask a third dumb question, you're cut off.
Yeah.
No, you have the credit card on file and you're able to just like hit us with a, you should have known better fee. I don't know, something like that. I mean, like the HOAs do, right? So what we're all looking for and asking for and begging for is resources so that we can help our borrowers and our realtors. That's what we're begging for directly, and not have to, we can't wait. It's too late when you get a loan into the system. You got to know this stuff up front, right? And so we can get all the reports and all the budgets and all the insurance and all that, but we're not the experts. And so I think that, again, for us to think that we're going to look at something and go, yep, that one's good, is nonsense and crazy and should not be done. And so we really do need something, and again, maybe this is part of what the realtor should be and will be in the future presenting to their seller as an expense that they just need to pay. Okay, you're going to do a home inspection and you're going to get, you know, a preliminary whatever it is on your HOA.
Right. And so
what the thought
to address that, we have offered, and actually this was Tony's idea, I want to give him the credit, is we can do a budget only review. We can do an insurance only review. And even some of our clients that we do full reviews for, where they underwrite their limited reviews in-house, they still send us the insurance and or the budget, because their underwriters are like, look, this has just gotten too gnarly. Like, okay, we can do the rest of this, but Inter Island needs to look at the insurance and the budget. So
Inter Island, I can't say your name enough. Inter Island.
We pieced that out, so that, like you said, like, and again, the key, and I know I've seen this in the chat too. Yeah, it can be really hard to get that stuff from the HOA, but the more we educate people and the more we get the sellers have this stuff ready to go, like, you know, you put in an offer and you get this information that I am legally, you know, not required. Well, yeah. And I guess in some places, I mean, required to receive, that it's ready to go. And you can get somebody who knows what they're doing to quick look at the budget and the insurance, because short of like litigation or excessive delinquencies, those are, I would say, the two biggest pitfalls, right? Yeah, you're like deferred maintenance, but you know, and again, you know, you would hope, and in lots of situations, you know, the sellers are required to disclose these things. They can't hide this. You know, if there's been an inspection in the
certain states,
project, you know, anything's been red tagged, they failed some sort of inspection, they've got open building code violations, and this stuff needs to come out early.
Do you remember the good old days when all we really did think about was litigation and excessive delinquencies?
Yes.
Things were so simple then, and we had no idea, right? So just one more time, their website, which we'll put into, when we post this on the YouTube channel, we'll embed it into the YouTube page, condoreviews.com. And somebody's asking if you have a blog or an Instagram place or anything where you share information.
We do some on LinkedIn, but we really stay pretty busy. So
no. All right.
Yeah.
So we'll take listen. The answer was the answer was no. Okay, moving right along. And then somebody asked, what is the name of the report that's run to make sure all is okay with the condo project?
I mean, CPM is about, and you can also, like, Freddie has sort of an analogous, it's loan project advisor or condo project advisor, and that addresses certain of the ineligible characteristics that are in section 5701.3 of the Freddie guidelines, and that will give you a green, an orange or a yellow, and then a red. And red is the equivalent to unavailable. Green means that Freddie has looked at it and decided it's not a condotel. You know, they own all of their amenities and, you know, certain features, but a green never incorporates insurance or deferred maintenance.
Okay.
So there really is no, and technically though, I do want to say that the guidelines state that if a whole project is FHA approved, that there is reciprocity with Fannie and Freddie. If you look a project up in the FHA database.
Wait, whoa. Hang on. Okay. So it's really nice that you just said FHA. They were my next, where I was going next. Did you just say if it's on the FHA approved list, then Fannie and Freddie will honor that?
That's what the guidelines say.
That's what the guidelines.
Have you seen that happen?
No.
Okay. So it should, but it may or may not. Okay, got it. So let's talk about HUD for a minute. Let's what is the difference at this point between FHA and, I mean, in a nutshell, and the GSEs?
I think the deductible thing is
the big, did you already talk? Well, the big things are like a single unit approval. You need to find out from HUD what the concentration is of FHA units. They're the only ones that know. And then we can go and do a review. It's a pretty similar review process. They have their own questionnaire. they're very strict on reserve allocation in a budget. So we can't exclude items like we can on conventional. Has to be a straight up 10% reserve allocation. The fidelity coverage requirement is usually higher. So it's like 3 months assessment income plus any money they have on hand in a reserve account. So that's usually, those are two that usually trip up a single unit.
Yeah, approval. Absolutely. Those are the two biggest things that if you're trying to do a single unit approval.
Yeah.
I mean, without question, because that's a pretty high fidelity requirement.
Yeah.
So, and again, we can't back out, water and sewer, which in some places is like 30% of the budget, like the income. And we can back that out from that calculation. With HUD, you can't, it's a straight line. Yeah. So anybody can do that math. You can see what the income is and how much they're allocating for reserves. And if it's not 10%, you're done.
Okay.
For FHA.
So if a condo is paying for water and sewer, that kind of hurts them in a way.
Well, yeah, I mean, I guess. Yeah.
But in lots of ways.
You have to have higher reserves.
It's unavoidable for FHA, but with conventional, we can back out, cable, internet, water, sewer, any of those kinds of utilities that a homeowner would normally pay on their own.
Mm-hmm.
Those can be backed out of the annual income, which makes it easier. So it's not a true 10%.
Right.
But and I was telling Audrey this offline, so you've got that higher, basically budget threshold and a higher requirement for fidelity. But we have been told directly by HUD, because the guidelines are not entirely clear, that they currently do not have the 5% cap on the deductibles. So if you have a per unit deductible that's 6%, or you have a 7.5% wind deductible, that's okay for HUD. But you got to make sure your budget's straight and you have enough fidelity. So it's an avenue to get around one problem, but you may go headfirst into two. But I just want people to know.
And they could change it.
Yeah, I mean, and it's apparently under discussion, but it is the federal government, so I don't see that happening very quickly. So, but just,
it doesn't happen quickly, but it could happen overnight.
Well,
right? It's like it could have been in the works the last 5 years. No one said anything about it. Then poof, boom, it slaps you upside the head. So that's what we have to be aware of. And so obviously we'll be keeping in close touch with you guys. And so again, we've already talked about this, but I see the question that was just asked again. Do you provide review services directly to an individual LO? And I'm going to say they're working on a service of some sort for LOs and realtors. And, the trick about that is, let's say a realtor takes a listing, goes through the process of having the HOA vetted. We know what the deal is, and it takes 3 months for that thing to go into contract. You got to make sure that you're updating it as you go, or do something, because if it changes in the middle of all that, that can impact what your buyer can do. So let's talk just for a moment about non-QM, because you handle that too. And when I'm having conversations with non-QM lenders right now, they're like, yeah, we're not doing any of that stuff. So tell us what you're seeing on the non-QM side versus the GSEs and HUD.
So we have at least 5 different lenders that do both conventional and non-QM. They've given us their non-QM guidelines, and so we review, just against that. And a lot of those come into play for condotels. So, they have lots of Airbnb, highly transient, too transient for Fannie, sometimes okay for Freddie. What's interesting though, is that a lot of the non-QM guidelines that we're seeing, they're still putting in that 5% cap on deductibles.
Okay.
So, and again, if you think this through, it's because if there's a catastrophe, that means that the HOA is coming out of pocket a bucket ton of money to just make their deductible. So this is strictly, a financial health stability, kind of concern.
Yeah.
But whereas you might think now, and this is not across the board, like some of them don't have it, but it has been surprising to me how many of the non-QM programs are putting that 5% cap in also.
So you definitely want to check with each individual lender as we go, as we always do. But also, again, the trick is we want our borrowers to be healthy and whole when they buy something, right? So, whether or not you can get away with it and a guideline is one thing, but making sure your borrower has all the information they need for the future is really critically important, right? And so
I remember during 2008, I had a good friend of mine say, "Hey, I got this great tip from my CPA about a condo in Marin. Marin's a pretty wealthy part of the Bay Area. And I can pick up a 2-bedroom, 1-bath condo." This was during the 2008, 2010 area. I don't remember what year particularly. And he goes, "But I can pick up this condo for only $80,000. But the condo association requires that no mortgages be placed on the condo." And I'm like, that's sending off a lot of bells and whistles in my mind.
Yep.
And I go, I think you need to do a little more due diligence on this, because something doesn't sound right, that they don't want a lender reviewing the condo association. Turns out the entire condo complex was condemned.
Condemned, like
condemned. Yeah, coming down. So he was very thankful that he hadn't spent the $80,000 on the condo that wouldn't be existing for a few more months.
What
unbelievable. Holy smokes. I mean, I've heard stories where somebody buys a condo and then 3 months later there's a $60,000 assessment. But that's horrible, Kevin. Okay, I just want to quickly mention that the Biden administration, and again, we are very clear that we are agnostic here. We think they all have issues. So I'm not calling it out.
Not picking a party.
Anything. What?
We're not picking a party.
We're not picking a party. God, no. If they wish. The Biden administration is imposing sweeping new flood protection requirements on homes that are built or repaired with federal housing aid. Despite industry warnings, the policy would increase construction costs. The Department of Housing and Urban Development, HUD, is publishing a rule that this morning to protect new and rebuilt homes funded by HUD from flood damage by requiring them to be elevated 2 feet above the local flood level. The final rule also enlarges the flood zones where the elevation requirement applies. So everyone needs to be thinking about this as we're running floods reports and making sure that, we are factoring flood insurance costs into somebody's PITI. What do we call flood insurance? PITI FI? Just kidding. Okay, so they are acknowledging that the elevation policy will increase the building costs, and they're saying by up to $7,800 for a single family home. And I'm like, $7,800 to make sure you're 2 feet above the flood zone or flood levels? Yeah, right. $7,800, $78,000, $780,000. It's one of those numbers. So anyway, but officials say it will save homeowners money in the long term by preventing flood damage and reducing their flood insurance costs. HUD right now requires homes that it finances to be situated at, but not above, the height at which flooding is likely to occur. The policy leaves homes vulnerable to intensified flooding due to future climate impacts, such as rising sea levels and excessive rainfall that overflows streams. So it's going to take effect June 22nd. It applies to every home or structure that HUD helps build or substantially repair. And they're also saying that the timing is very significant, because if they do it now, it'll make it harder for Congress to back it out later. But it's gonna, again, this is gonna be something, and they may be right. Like maybe if we were 2 feet above the flood, the flood levels, maybe that will be a cost savings down the road, because we're not going to have as many homes washing away. I don't know. Anyway, and I think it's interesting too, single families, but not condos, not anything else. Like, anyway, whatever.
Audrey, can I jump in really quick? Just another thing I want people to remember is that Fannie and Freddie require that a condo project that's in like an AE or a V flood zone, so what we would just want to call it in a flood zone, the master flood policy has to be 80% of the replacement cost estimate. Okay. The borrower can make up the rest, but if you're doing loans in projects that are in flood zones, that's another thing you got to be sure is that the master policy is at least 80% of the estimated replacement cost.
Wow.
Whew. Okay, so to summarize, Holy smokes. And we are going to get your contact information and put it on the bathroom walls and in the YouTube channel. If anyone has questions that they want to ask directly or wants to understand how to
By the way, record number of questions we've gotten on
yeah,
this.
I know. I mean, I'm a little, you should be
Like,
terrified by
wow.
this. You should be terrified. Anyway,
You are very best.
again, well, I think that again, prioritizing your idea around a subscription service is really important right now. So you might want to be that to be your next lunch meeting. Anyway, so we'll let people know how to get in touch with you. You're welcome. And if you have any, and you guys will keep us updated. Yes.
Absolutely.
Okay. Yeah. Please, please, please. So, and yeah, we'll keep everyone else updated on this too. So with that, we will see you next week. Same time, same place. Tuesday, 11 o'clock. I had a brain twitch there. Can you tell? Tuesday, 11 a.m. Pacific, 2 p.m. Eastern, or wherever you are in between. And thank you so much, Tony and Maureen. We really, really appreciate all the information. Yep. It really does help. I mean, that was a lot, and we're really grateful.
Thanks for having us.
Thank you.
Thank you so much. Have a great week, everyone.
Bye-bye.
Bye.
Bye-bye.